Hi,
Yeah,
we are live.
hello.
Okay.
Okay.
Uh, okay. Couldn't hear anything as usual, but hi everyone. What is up? So I got my headphones today because the kids are actually in the house and there's my friend's kids is a little noisy. But Happy New Year! I think it's our first time in the new year that we are live in your platform, Sifu. So yeah, how are you guys? How hopefully you guys are doing great. Again, if you guys are watching us, we have Academy. So who are we? Our mission is to basically empower people uh, to grow their net worth through stocks. It's as simple as that, right? And it's all about empowering, and we want your financial independence. We want your financial well-being to be better. So yeah, so that's basically what we do. And my name is Warren Howe. Yep.
Hey, my name is Shafiq.
Yep, I'm the FY, what we call the FY investor, and Shafiq is the FY trader. So this Happy New Year, David. I saw your comment. Yeah, so David,
Hey guys.
who's watching. So guys, it'd be appreciative if you guys can show us whether you are here by typing something in the comments, right? Smash that like button, smash that heart. Type in, hashtag live if you're watching this live right now. If you're watching on replay, you can just type hashtag replay so that we can. The goal is to actually interact with you guys. That's why we are doing live, right? It's not like, yeah, I mean, seriously, if you want to watch us through video, you can just subscribe to our video and drop a like and see our videos. But that's the
Subscribe to
beauty
our
of
YouTube.
live, right? Yeah, but anyway, please do subscribe to our videos. Subscribe to our YouTube. We have
YouTube.
a new YouTube,
Yes.
and yeah, maybe we can post it in the comments later. But anyway, so this episode we something interesting because I think it's something that we need to talk about seriously, right? 2022 is actually quite a hard year in my opinion for U.S. stocks, growth stocks. So Shafiq is going to share his opinion on the Bursa market, which I'm pretty sure everyone else is sort of interested to know about. I will share my view on U.S. market, and yeah, basically Happy New Year, guys, and let's begin. David Tan L Hawk. Thanks, guys. Thanks for tuning in. So, what is our view, Shafiq?
I
Well,
think first we need
yeah,
to, I mean,
yeah,
for us that managing portfolio, right? For us
yeah,
that trading in the market, investing in
yeah,
the market, we need to really understand the risk of what happening in the market. So I think we should discuss about risk on 2022, right? So
for sure,
I believe we have something to talk about that.
for sure, we do,
Yeah.
for
Yeah.
sure. Okay, yeah, that's the most important thing. Like, this is exactly what we talked about with our group. This is exactly what we talked to my own coaching clients. I coach people in the US. This is exactly the same thing, and is good to be mindful because our money is in US. I'm not sure about you guys. Our money is also in Bursa, so we actually have that good hedge in a way. And when things go, turn out to shit, when his shit hits the fan in one market, hopefully the other, can pick it up. But yeah, we want to discuss about that, and it's good. And I want to share my screen. Let me share my screen here. So share screen. Let me see window. Okay, there we go. Okay. Now, I'm quickly going to jump in here, and
Still cannot see your screen.
yeah, I know
Okay.
I don't know why it's
All right.
loading, but okay.
Okay.
So, so we're talking about risks. Okay. Now, let's do a little history back track, right? Little TBT, right? Hashtag TBT throwback. What happened in 2018? What happened in 2019? What happened in 2020 and 2021 were all different sort of events, and obviously a little different ways of investing, but the philosophy should be the same. But let me touch on the risks first, right? So back in 2018, if you guys have been following the market ever since then, you'll know that towards the end of the year there was like a mini correction in the market, right? The S&P 500 actually dropped like 20-30%. Now, whenever the S&P 500 drops from the highs to a 30%, that's like a bear market, right? I believe it was 20%. But whatever that's below 20% is considered a bear. Yeah. Now, what happened? And I'm going to show you guys this graph. Yep. So basically, why am I backtracking is because it's important to know what happened, especially on the yields. The story about this year is that Real yields, interest rates, they are expected to go up to fight inflation, right? Bottom line.
Yep.
So when interest rates go up, I want to show you guys the correlation as to how the stocks move in lieu of these events. Yeah. So that's why I'm showing this graph. Okay. So this graph is very simple. All we got to know is the red color is the Russell Growth Index, which is indexed 1,000 stocks. Russell Value Index, same thing. And this movement is the average PE ratio. Okay. The black is the 10-year real yields. Now,
Inverted.
yeah, inverted. Okay. So what it means is you see this x-axis here. We got 0% here. If let's say real yields go up plus 0.5%, plus 1%, and then minus 0.5% and minus 0.5% and minus 1%. That means the real yield is actually, decreasing or increasing. What will happen to the PE ratios? That's what I want to share with you guys. Okay. So the black is again is the 10-year real use, and people look at the 10 years, right? Later we'll talk about yield curve inversion, but this is the correlation and how the movement is whenever in different times. So in 2018, during that that mini correction, interest rates are up because I mean that is like the economy is actually getting better. 2019 was one of the best times in the economy, especially the best times for the S&P 500. Okay, so when the real yields go up, you will see also stocks following to go down in correlation. So you got so this axis is the real yields, and on the right it's actually the PEs, right? So you got 10, 15, 20, 25, 30, 35 PE. Okay? So what you can see here in the end of 2018, growth growth stocks on average was at around 17 to 18 PE. Okay? Value is at 12. Yep, you can see it here. That means when interest rates go up, PEs will eventually follow. Now, the PEs doesn't mean that the earnings actually go down. It's because of the stock price goes down. That's why the PE is actually getting cheaper. Okay. Then after that, 2019 had the best year. Interest rates, they decided to lower down interest rates after after stabilizing. They lowered it. So as they lower down, the P's follow accordingly in tandem. Okay. Then COVID happened. Then after that, lowering all the way. You guys already know, right? We got stimulus. We got, what they're basically pumping in money, right? Liquidity. Then obviously, the interest rates are actually close to zero, right? So that's what happened. Now again, we are fast forward like that. That was just a little backtrack. Now fast forward to 2021, yields again has been low. Growth PEs have been high. Value P's, however, has been a little stagnant or is still dropping. So I'm showing you guys these for a couple of reasons. Okay, number one, in this environment right now, why why do they need to raise interest rates? Because inflation is a bitch, right? Inflation is CPI. Inflation is at 6.8%, and things are getting crazy. Asset prices are going up because everything is because of the ripple effect of the backlog from COVID. Okay, so in order for the Feds are actually having a tough time. They're trying to say that okay, we need to raise interest rates to match up with inflation so that we can, but they can't raise too much or else there'll be a recession for sure, right? Companies can't expand, they can't borrow money on cheap, they can't expand. That's the name of the game. And when interest rates are low, you see the housing market boom like crazy. Median price of house like the housing market. I was doing research right back a few months ago, last year. The median home pricing was at 600K. Right now is at 800K. That's how crazy it is. Okay, the property market is a boom. So that's where I was thinking, shit, why did I not invest in real estate developer markets? Fucking hell. I was investing in prop tech, right? Redfin. So yeah, because real estate property development developers in US, stock price gained 45% year to date. 2021, 40 fucking 5%. They beat the S&P 500. Okay? But anyway, moving back to this. My question is the reason why I'm showing this to you guys is in an environment right now, right, where Fed's already admitted that hey, inflation is not going to be transitory anymore, motherfuckers, and they're telling us that okay, we are going to raise interest rates, right? And this came in the news like faster than what I expected. Like holy shit, I expected like maybe the first quarter raise interest rate, but what the heck? Like literally after the Santa Claus rally, they raise interest rate. These fuckers like they can't let us have a break, right? So 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 okay, my question is, what is the likelihood that rates will actually go down further, or will rates will have is there a better chance for the rates to actually go up? That means this line right here, this black line, will it continue to be minus territory or getting up? That's the question, right? Well, obviously, if inflation is not transitory, but I don't believe inflation will be fucking lasting for like 3 years or 2 years. Like, to be frank, I think this inflation will go out in 2 years. But I mean, I can't time the market, so we got to do what we do. So when this means that if let's say the black line continues to go,
Down.
down, growth PEs and value PEs, what is the likelihood that these guys will actually go down? Obviously, it's going to be in tandem. Okay, that's how it works. How it works is that if interest rates are going up, money flow will be going to safer assets because it's not as attractive anymore on riskier assets, and that's why high growth stocks that we are also heavy in are in trouble. That's number one. Okay, number two is we could have opportunity on value stocks because value PEs have not really, moved, right? It's not really, I mean, obviously, the beauty is that we can invest in individual stocks. That's the best case because we know the earnings, we know the story, we know the growth of this company. We don't care in any market situation as long as they can survive, they can ride it through, right? That's the benefit of individual stocks. But looking at the macro view, is there opportunity on value stocks? See, that's number two that I want to point out, right? So these are things to be mindful of, and the third thing is actually we got to ask ourselves how. I seriously, we need to have a basis that shit. Will the Fed fuck us up again this year? And if they raise interest rates, how high can they raise interest rates? 2019, which is one of the best years, right, for the S&P 500 and the economy, rates were at like what 2 to 3%. The maximum is at 3%. They can't afford to go higher than that. If they do, then it's Armageddon. But I mean, what I'm trying to say is people shouldn't panic because we are not even at 2 to 3%. Even if the worst case scenario at 2 to 3%, stocks are still running the same game. People are still investing the same way. Companies are still earning, right? It's just not as an attractive thing anymore. So what should we be mindful of is like seriously, if you like, here's a trade idea, Fee. Maybe
Yes.
we can short ARK Invest stocks.
Exactly, because arguments is growth free, right?
So here's the thing, right? I mean, ARK Invest is investing in those like genomics, fucking cash burn stocks. Like seriously, burning cash without profit, burning cash with lower cash flows, negative operating cash flows, burning cash with the money that they raised up probably from convertible senior notes.
Mm.
So the market is punishing these type of companies, whether we like it or not.
Also,
So
just
that
imagine that if the interest, the higher interest, they basically have a higher cost of operation, right?
yeah, 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 that's true. Higher interest means when they want to borrow money, it'll be
Yeah,
more expensive.
yeah.
So you got like you got like tight bloody big ass companies like Apple borrowing money in a low interest rate environment. That's why they have a lot of debt. But they're smart, right? It's practically it's not free, but it's very low. And over the years, this is as low as it gets. So why not take this opportunity and just raise some cash? They can pay it back anyway in the long term, right? Because they're
Yep.
already stable and So this is strategy, right? This is corporate strategies. But for genomics and most of the companies that are in ARK Invest funds, I mean, seriously, if shit hits the fan, they might go bankrupt. Even in a better environment when interest rates are low, I said this before. The fact is, some companies in the ARK Invest might go bankrupt. It's just, you know, it's it is what it is. So that's what I want to share. Okay, there's three things that we need to be mindful of. Actually, there's a lot more things, but these are one of. I mean, these are the main important things that we have to know. What is the likelihood that if interest rates go up, how will that affect growth stocks? And what are the opportunities that we may able to capitalize on for value and safer hedging plays, right? So obviously you guys know the drill. If let's say recession hits, then the stocks that we want to invest in will be staples, defensive stocks. I'm talking about US, right? Because in back in '08, if we invested in Dollar Tree, we would gain 50 to 60% when the whole S&P 500 is actually down 35%. So that is a hedge, and that is being ready. But there are a lot of strategies that we can adapt. If you tell me, hey Warren, the reason why I got into SoFi, Palantir, whatever growth stock that you tell me, is because I already done my homework and I already done my projections. In 5 years' time, regardless of how the market is, they will do X amount. They will deserve a X of market cap, X market cap. That means you have done your homework. If you have, then great, right? Because your strategy is you're going to hold anyway, and the money that you put in, you are willing to risk it out. That means it's not hindering your day to day. Your wife is not going to kill you. Your spouse is not going to kill you, sort of money, right? So if you're doing it that way, well, go ahead, go ape shit. You can do that. But if you're actually, you know, if you are dependent on the money, well, don't simply buy on the dip. That's what I want to say. In this environment right now in US, it looks a bit gloomy, right? And what the worst case scenario is, it might be like a staircase scenario. What is the staircase? Staircase is like, okay, it's going up, then it goes down. When it goes up, people are like, oh, you know what? It's coming back. Stocks are coming back. Oh shit, then it goes down again. Then it goes up and oh, it's coming back. Then it goes down again. Fucking staircase. It might happen like that. So this whole thing might happen for the whole year because the Fed is sort of fucking us, right? The whole year they said that okay, they might raise interest rates for 3 times, right? When they raise 3 times, I'm out. I'm fucking out. Okay. No, I mean like okay. Well, what I mean by out is that I'm not gonna sell my Teslas. I'm not gonna sell my long-term holds. But our strategy, like what we discussed with our group, is that we want to be more like in and out in the market. So that's where we have that beauty, right? Shafiq, you take care of the shorter term plays. We look at thematic plays, right? We look at I mean, the beauty of Fata. We look at like ideas for like let's say seasonality on let's say certain retail companies, right? End of the year, most likely their retail sales will be good because of discounts and whatnot. So what are the companies? And we already have a company, but we don't wanna follow us on YouTube. But yeah, we want to raise it up. But yeah, we already have a company. We got an idea. Hopefully it plays out. But these are the things that we need to have, and we tell ourselves that okay, when we go into these trades, it's all good. Like we don't need to fucking hold for 5 years. No, I don't want that story. I want like boom, fast. Right? It could be 1 hour from trading. It could be 3 months from thematic play. It could be 2 weeks from something. Right? Beyond Meat. Beyond Meat landed a KFC deal. Boom, up 15%. Okay, I'm out. That's all. Right? High max value play up fucking 35%. Suddenly down 6%. Okay, we are out. We cashed out. Sold. That's it. That's for that. When it goes down again, we'll buy again, right? So that's our strategy, and that's what we have reserved for like 20 to 30% of our portfolio. And again, guys, we started a portfolio. We've been posting on Sifu. We started a sort of a public account, right? 3,000 USD of our own money, and hopefully, fingers crossed. So far, we are up like what? We were up actually 15% in like 2 weeks. But because of COVID, we're holding Tesla, we're holding SoFi. Then okay, let it go down. It's fine. So now we only have like 9% in the beginning of the year, but that's fine. I mean, we still have the whole year to go, and hopefully we can get some substantial gains in that account, right? So yeah, that's our strategy. That's our strategy. We want to be like a one night stand. We don't want to be marrying a stock. Like our team, whenever someone pitches like a long term stock, like, no, 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 no long term. Let me go for this year. Okay, we go this year because we want to beat the S&P 500, which is stress to ourselves, but we can do that. So I want thematic plays, right? When we go in at a high thesis, high conviction stock, boom, we're gonna hood it big, right? So yeah, that's what we intend to do. But yeah, we have to be mindful. That's why I'm actually
And
sharing this graph. Yeah,
yeah,
yeah, go
and
ahead.
also it's not necessarily that we're not playing. It's not necessarily that we're not looking into fundamental for long term play, right? We're still going to looking for this kind of company that might get a good return in 5-10 years. Just that we are going to be more sensitive with the price, right? That's why we combine this fata. Let's say, right, if you have like a company which is we think that all right, the fundamental is good. This is probably a little bit of combination between value and growth play, but the price have been quite uh, not as good, right? So we're not going to wait and just invest, wait for nothing, let the stock price go down. We're going to be more sensitive. We're going to see more opportunity to make more money. That's basically our strategy, right? Not to say that we're not going to look for investment play, right? It's just that more price sensitive, right? In
That's true.
this,
That's true.
yeah.
That's true. But I just want to tell them on the allocation. Like we should be more
Okay.
concentrated on, you know, faster and hopefully faster. Right? Hopefully it plays out. Yeah, these sort of plays. I think David is asking a very good question. He's like, okay, what's the main challenge for investor in year 2022? And so I'm going to answer on the US part. Like, if you invest in US markets, and it's different, right? Because Shafiq has his own thesis on Bursa, which he'll share later. But my point is like the challenge for investor is that first of all, what type of investor? The only way retail investors can beat analysts and beat fund managers is that they hold out long term. The name of the game is to accumulate more shares of a high conviction growth company and just fucking laugh all the way in the bank 5 years later. That's how you can beat the market. Seriously, that's how it's done, right? It's proven. People are rich from this, right? It's proven. So the challenge for our side is we are living off managing funds. So our challenge is that, oh shit, we're gonna meet that 1 year gain. Like fucking hell, we're
Yes.
gonna be stressed out, right? So that's the challenge for us, right? That's the challenge. Oh, we wanna this is what we call seek alpha. We wanna seek alpha, right? We wanna seek value, we wanna seek, you know, any we want to capitalize on any opportunity, right? So that's the challenge here because right now it's not 2020 anymore. It's not 2021 anymore, right? But there's some obvious plays that we want to reveal later on. But I mean, 2022 is a different ballgame. It's like a different landscape already. So again, like what Shafiq said, we need to be selective. We need to be this. That's the challenge because our usual high growth plays that we are more, research more on, might be fucked up this year. So that's the challenge that I think, right? But again, if you are long term and all that, then that's fine. I mean, you still back to your thesis, stick back to what
Stomach
you
the
believe and
volatility.
understand. Yeah, stomach the volatility. You have to. If you are investing on high growth stocks for the long term, and don't lie to yourselves, you will know that high growth stock is going to be boom. And when it goes boom, you need to bite the bullet and say, "Fuck it, let me close my account." I mean, not close the account. It's like not C. Okay. Um, yeah, that's what I think. You need to fucking stomach the volatility. But if you got some extra time in your hands, like what Shafiq said, we're not just going to say sit and wait and say, "Oh, you know what? Let's not do anything." No, fucking hell, we're fucking researching the market and okay, what is to do. So that's where we are a little bit more active. So if you're, if you want to be more serious in the game, maybe you can join our group, right? We can post the link in the comments and whatnot, and yeah, follow us on YouTube and subscribe to us. Yeah. So yeah, that's on my side. That's on the US side. Okay, that's on the US side. Like the whole macro is gloomy in a way for high growth stocks. And to think about it, we need to think about deals. We need to think about valuation. Mark, the market right now, Mr. Market, is punishing those high growth stocks that have no earnings, and they're saying that okay, PS ratio of 25 or 30 is too high. So that's PS ratio or PEs. I don't know, whatever that you want to call it, right? The PE is an easier example. So companies that are 50 PE, no, you deserve to be all the way to 30 or 15 or 20. So for those of you that have cash, this is your world. Again, I've been saying it many times. I said it before. I remember. Liquidity is king. Those who have cash in harder times in the market, you guys will be laughing to the bank because you're getting better deals versus the guys that have been buying at the top, right? So, the people buying at the top, they're losing 35%, 30%, and now you're laughing because you bought a little lower, right? You got your margin of safety. So, I mean, investing is still the same. You still need to work out your margin of safety. You still need to work out the long term goals of your stock because every different stock has different, earnings growth, sales growth, whatever, right? Their own story. So that's still the same. But if you're willing to hedge your, portfolio, then maybe go into value plays, defensive stocks just to hedge, or maybe you just keep cash. But think about it. What is a better way that other than just keeping cash? You could invest in a business that is producing good cash flows, and maybe I will deem like maybe Google similar to holding cash. That's one of them. Big tech, right? I will maybe even deem like Walmart or Dollar Tree like holding cash because they're secular growth companies, for example. So that is another question also. Like instead of just holding cash, maybe we can hold going on to different type of stocks that are more stable rather than our, Palantirs or rather than our genomes or whatever the ARK Invest is holding. Roku, right? Oh my god, Roku is beating out like crazy. That's number two position in ARK Invest, like a dog, beaten down like a dog, man. But anyway, yeah. So that's what I want to say. So that's on the US side. What do you
But
think
but
about the
I,
Malaysia
I
side?
also
Yeah,
interested that
yeah,
a lot of technology sector still
yeah.
in growth play, right?
Okay.
So what's your opinion on technology sector, and probably you know share
Sectors.
some of sectors that you also
Okay.
think
Yeah,
that
yeah.
might be
Sorry. Yeah, yeah,
potential
yeah.
in
I forgot
2022?
about that. I forgot about that. Okay. Um. So here's our strategy going moving forward. We already revealed what we're gonna do, but here's a little bit more detail. Okay. The fact is that certain commodities are still going up. Okay. The fact is, semiconductors demand is as high as the roof. The shortage is real. So knowing this, maybe we can invest in semiconductor stocks. And by the way, I just knew this. We just knew this. 12% of US GDP is reliant on
Taiwan.
Taiwan semicon. What the fuck, dude? I didn't know that. Like, holy shit, 12% of GDP? So what does that mean? Because Taiwanese, they have foundries, they even have fabless players, right? Semiconductors. So like Qualcomm, like TSMC is the biggest foundry, right? I'm pretty sure that's contributing most of the of that 12%. So TSMC is the biggest foundry. The fabless players like Qualcomm, AMD, they sub it to foundries, they do their shit, manufacture OEM, and then after that they give it back, and then they send to Malaysia to OSAT or whatever, right? That's the whole value chain. Depends on where it is. There are plenty of OSAT players, right? But that's the sort of little cycle the value chain that we're talking about. So knowing the chip semiconductor shortage, that means high demand and better prices, and that means better earnings. So maybe I'm not forcing this, right, guys? Maybe we can look at semiconductor plays, and this is what we are personally looking at for this year, right? Because there's still, I mean, we can look at facts and figures. Silicon metal is still going high as hell, okay, and that will be reflective of the earnings, right? That's commodity play. I'm not a fan of commodity, to be frank, but there are certain places that we can go. Semiconductors are still a shortage, so there's going to be another boom there. What else? What else do we talk about, Fig? Like these two are the obvious ones. Um,
Commodity play more like you know um, so basically if I may add, right? So
Yeah.
I would say that we are bullish on uh, steel tech, right?
Yeah.
Semiconductor play. Next, we also quite bullish with the um, renewable energy, good governance, ESG, all this kind of
Right.
thing,
Right.
right?
Right.
And this is less bullish lah, like mid bullish lah, mildly bullish, probably on oil, but still that not not our biggest bullish, right? We
As
just see that it's a trend play lah, right? Um, because there's a when we talk about inflation, right, we must understand that this inflation is due to supply disruption or due to demand, right? If it's because of supply disruption, right, of course, for to make everything equilibrium and work in normal again, right? Those semiconductor supply that have been disrupted, right, and basically because of COVID and whatnot. And during this time also, the demand have been increased. So it just makes sense for us to invest in this company because the supply is disrupt, the demand is increasing. So it just matter of make a matter of sense, right? That you invest in this kind of company because eventually people will put money to to increase this kind of play because this is where we heading to, right? When coming to oil, right, oil and gas is basically quite tricky. So that's why we more like looking at thematic play rather than like overall 2022 bullish. And in fact, in oil and gas, it's going to be still very volatile. So, but we have like good indication and good analysts that that hinting that oil and gas going to uh, trending lah, right? So we still on energy play. So energy play is also related to renewable energy, oil and gas and whatnot. Because this is uh, when everything is recovered from COVID, right? Economy shutdown, energy going to be being used more, right? People want to open factory, people want to delivering the item. All of this use energy, right? So yeah, and probably property. Do you bullish on property? Or I forgot. Property
for
bubble.
US,
Property is bubble, right?
there is a chance for it to go up. There's a chance for it to go up.
Right.
Yeah, there is a chance for it to go up. I want to share my screen. How come I can't share it though? I press share and I'm not sure
Yes.
what's happening.
Admin, please help us.
Yeah, I want to share my screen. I'm not sure if Phyllis is hearing this, but yeah. Anyway, the reason why I want to share my screen is because I want to show FinViz, and in 2021, the better performing sector, the best performing sector is energy. Oh, there it is. So energy, we can see here, 35%, dude. Real estate 24%, financials 21%, and technology just at like fourth place. Industrials, whatever. Everything is green. Uh, but yeah, that's
This
that's
in 2021, year to
yeah.
date,
This
one
is
year. Right.
2021, 1 year. So, I mean, why am I showing this? Is because energy has already gone a huge run up. Energy has already gone a huge run up, and that is quite obvious because the 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 price was low to mid. I think it's now what $70, right?
70.
So
You
so what's
mean
the
crude oil, right?
yeah, yeah, yeah.
Yeah,
So
70
what's the likelihood of that 70 going to 100? I
less.
I think not high lah, right? I think the
There,
chances are
there's
not high.
there's analysis
So
that is saying that less than 10% probability for the crude oil to drop to go as high as $90, right?
oh
I'm saying
really?
that
Wow. Okay.
yeah. So and to less than 20% for the crude oil price to drop back to $60. So I'm
Okay.
not saying that we are bullish, super bullish that we're going to go up to $100, right? Just that the trend is that, right? So we're going to ride the trend as long as it's still trendy. That's all, right? And
Okay.
that's why I'm saying that we are midly bullish, right? Yeah. So that's about US market, lah, right? Anything you want to add, Oren?
No, no, no. That's all I got. That's all I got.
Okay. So for you, for Malaysia, right? Actually, it's still going to be trickier. Um, Everything in US quite
Oh, sorry,
direct.
sorry. Midterm
Sorry.
election. Midterm election.
Yes,
Midterm
determination.
election. US. Now that's gonna fuck up the markets even more also. So what I'm trying to say is, even a bigger scale, there are more headwinds than tailwinds.
Mm,
So that's the pressure. That's the whole Mr. Market giving pressure on stocks, especially on the growth stocks that we talked about. So we got midterm elections, we got you know tapering, we got interest rates going up. These are like good enough to fuck up our high growth stocks. Yeah. So this is yeah. That's what I want to say.
right. So coming back to Malaysia market, right? This is chart that you can see after budget 2021 announced.
Okay.
Stock market have been plummeting down to drop a lot, right? So why is this? Because there's a few policy that directly affected the market, especially equities market, right? First is tax, company tax. They introduced a new company tax. It's basically like windfall tax, but there's a few selected company that need to pay the tax, right? This basically company that really making a lot of profit, lah, right? That's a I forgot the detail, but basically that is the thing. And actually, that is not the worrying thing about this, right? Worrying thing about budget 2021 is basically when they announce there's an increase in duty stamp, right? Increase in duty stamp in stock market. So when that happen, right, it make a liquidity problem, lah, right? And it just doesn't uh, line well with our Malaysian stock market, characteristic. So and after that, right, the stock market have been drop until I think toward the last week of December last year. Government has basically like U-turn, right? They say that all right, the duty stamp only applicable for sorry they cap the duty stamp to $1,000, right? $1,500. So that is good news lah, at least, right? So I think that is more importantly, and that is what give the bullish in the market again. So my point is, when the market have been dropped this much due to we getting worried about this kind of policy, how it affect the stock market, and it turned out it's not happening, right? And stock already dropped a lot, right? So it's matter of time that the stock will recover back, right? So that's one thesis, lah, right? Another thing is also um, GDP for 2022 is expected to be better for Malaysia. So I think it's just like business as usual for Bursa Malaysia. But there's a very critical risk about investing in Bursa. And this is related to political risk, lah, right? And like everyone know, right? This year we're going to have um, an election, so that going to make market that is basically the headwind of the market, right? So it makes market become more careful, right? So and if anything happen to US market, right? We already discussed about US. Eventually, how people react
Follow
in
through.
Malaysian market will follow through, right? So yeah, so that is basically my point. Is like I basically just trade as usual in Bursa Malaysia, but I'm going to be very careful, right? And I plan to secure as much as profit in the first quarter, because it's going to be much more difficult in next quarter due to political reasons, due to um, yeah, and political is very huge because why? When we expecting an election, there's going to be pre-election and post-election, right? And we currently in the hands of uh, in the hands of government that still unstable. So if it's going to be like very difficult moment lah, right? Because even if when even if the election or be already done, right? People still wondering whether the government can deliver or not, right? So I think that is like huge risk in Malaysia market. And but talking about individual counter, talking about individual or talking about sectors, I think uh, 2022 should be much more better than 2021. 2021 basically we only there's only if you look at the overall sector, right?
Can we look at that?
Only yeah sorry, I don't have that. I only have from the story, right? But
Yeah, but no, it's fine. No.
okay.
Let me see. Let me see. Let me see.
Is
Or maybe you can find it out. Maybe you can find it out. And just let us know.
yeah, right.
Yeah. And
Yeah.
I
So
want to tell
basically,
you. Yeah. No, go ahead. Go ahead. Go ahead.
yeah. So basically, within this all sector, right, only two sector that traded in green, which is technology and I forgot another one. I think consumer.
So I want to say something fucked up that I don't like, right?
Go
Uh, yeah,
ahead. Go ahead.
but okay. While you're finding, let me just talk about it. Now, something fucked up about Bursa is that our thesis originally was that okay, COVID. I mean, after lockdown, COVID recovery is going to be better. In fact, recovery is there. It's just that small businesses did not exactly like seriously because of the government. Small businesses are really fucked. A lot of
Yeah.
people go out of business. They change the different game. Like the way of earning money for them is like different. Seriously, it's a sad story. So those who can't adapt, those who can't like innovate in a way, they'll get affected. Now, why am I saying like recovery is like I mean, why am I saying that I'm pissed off is that okay, when we think about recovery, we think about like what? Focus P, right? We think about, basically retail stocks. We
Yes.
we think about I mean possibly recovery plays lah. But when you look at the whole sector, like you said, right? Two sectors green.
Three.
What? Oh, come on. What the fuck? Three. Okay.
So
Oh,
yeah.
there it
So
is. Okay.
technology, industrial products, transportation.
Okay, so technology, industrial, transportation,
Mm.
finance, property. Property is going to shit. My thesis was that property would be doing better, but okay, it went to shit. Construction was the worst. Healthcare, healthcare. It's probably dragged down by gloves, right?
Yes.
But
Yes.
yeah, energy. So I mean, why are we showing this? Is because what do you think, Fig? Like maybe as I know in US, normally there's a rotation. Rotation meaning, okay, if let's say those were
The,
battered down in the last year, what will go back up? Because they're
yeah.
already beaten down, right? But will there be rotation play this year?
Okay. So basically, market still have its own rotation. Just that 2021. So what happened in 2021? We changed government, right? And a lot of um, government policy, all these things like not being very effective. So that's why I said 2022, right? The biggest risk is political risk because people
Okay.
already see what happened on 2021, right? There's
Yep.
uh, two change in hand in government, right? People already
Yep.
see what happened there, right?
Yep.
So people going to be more careful, so that they're going to wait and see first. They're going to, this
Yep.
kind of thing. So that's why it's going to be a biggest risk. People afraid that whoever whoever going to be the government next, right? Whether they can deliver or not. Because 2021 have not been very good for a lot of businesses, right? We're expecting recovery, but still because of COVID, because there's a lot of restriction, there's a lot of confusion in SOP law, all of this law. It's make everything difficult to straightly recover, right? But it's not to say there's no recover at all. It's just that this kind of sector have been not been in favor with investors. But 2022, I still think that right, this individual sector, individual counter going to have their own uh, potential lah, right? We're still going to find opportunity in the stock market. It's just that going to be much more difficult, right, coming to mid of 2022 due to election. So that's my point lah, basically, right? I think, and also what happened in US market, right, will follow through by Malaysia market will eventually not exactly follow, right, will be followed through, lah, right? The interest about it, people interest in the stock market going to be lesser because the trend is not there anymore. That's basically what going to happen or might happen, right? So, but coming when we talk about current time, because I'm as a trader, I'm just looking at current price. Okay, so uh, previous session we already talked about how to identify reversal in the market. And funny thing about that, right? After we mention how after we share about how to identify reversal in the market, um, during that day, right, market already showing the FTD, right, follow through day,
Mhm.
and start from that point, stock market already reverse. Okay, so now it's still doing good. Okay,
Oh, it's still
but
doing
this
good.
is still doing good lah. But
Okay.
still volatile, still volatile. But
I
this
thought
is
FTD become FTS. Follow through
this
shit.
is KLCI, and this
Okay.
is combination
Right.
of companies in Malaysia that I created. So this is the reality of stock market, right? This is basically all stock market from this point to this point drop a lot. I hear a lot of people, you know, losing their gain in 2021 just because of these few months. It's very sad. We we lucky because we already gain, and being very be very careful, right? At the end of the quarter, and in fact we already achieve our target, right? So we lucky for that. But if you see here, right, our follow through day is not here, right? Until there's is follow through day is here. So KLCI already rebound, already reversed, but the combination of overall market, the follow through day is late, right? You only see follow through day uh, last 3 days, right? So this is actually meaning that this reversal is not going to be a strong reversal, right? At least by theory, it's not going to be a strong reversal, but hopefully the follow through will be followed, right? And market continue to be trending, right? And that is also why I'm thinking that if you want to gain as much as profit, right, it should be in the first quarter, because everything aligned well at the moment, right? The risk in the next quarter going to be very challenging. So hopefully we achieve our target in the first quarter, and go more conservatively in the next quarter, right? Just still trading as usual. It's just that to be more conservative. Okay, so that is my overall opinion about Bursa Malaysia lah. Um, but at the end of the day, all right, we still need to invest in the stock market, right? Because when inflation is high or this, the only way that can
Yeah.
give you the hedge is
So
actually investment.
I forgot to mention that there's too many things coming in my mind. What I wanted to say is that when inflation hits, what
Mm,
do we do? Do we
yep.
put our money in FD? Do we put our money in bonds like what the US do? Like that's stupid. Your bonds you're getting 1%, or 2% in 30 years, year over year. You're getting decayed, like the money is decayed away from inflation. So what do? We have to invest. It's as simple as that. We have to invest, and we have to invest in riskier assets as long as you know how to, the replacement of cash, right? So that's where people, if they really understand that concept, then the stock market we still have to invest. There's without a doubt, right?
Yep.
Um, yeah, that's something that we want to
And
share as well. Yeah,
yeah, and the benchmark is pretty clear, lah. You, as long as your portfolio performance is not too far from index S&P 500, or
it's quite
KLCI.
hard, lah. It's quite hard to beat
Yeah,
the
quite
S and
high,
P.
but at least we have the benchmark, right? Like
Yeah,
if
yeah,
we
we do
close
for
to
sure.
the benchmark, meaning that we at least doing good, right?
Yeah,
We're not losing to inflation uh, a lot, but we still need to invest. We're still actively trading and investing. Just that we need to be mindful with the risk that going to come in 2022, right? And that is also really important if you want to really make sure that your portfolio uh, doing better, or you know because from there, when you identify a risk, it gives you the common sense on how to manage your portfolio better, right? Or how to do, right, during this kind of sentiment, what you should do and whatnot. So we already shares our opinion, how we see stock market in 2022, how we plan to to mitigate all of these risks, and how we run through how we operate our fund management. But how about you guys, right? So hopefully you guys can
exactly.
learn something from here, right? And also my point is identify and plan, right? So that is what we need to do, like, as trader investor. Yep.
For sure, for sure. So, and by the way, guys, our trader public account that we announced in the beginning of 2021, we closed full year performance at 90%, 90. We grew 33,000 to 64. We closed it at 64. Okay. Now that was our track record for that, and the whole overall bigger portfolio that we revealed before, it was at like it was up 23%. It was up 23%. So it's 3% off the S&P 500. But okay, we are still managing like a $1.4 million portfolio, ringgit portfolio. So yeah, we announced that on our YouTube. So check that out. Subscribe on YouTube. Yeah. Yeah, hopefully you guys got some value out of this today. We've basically shared our strategies, what we look at, what are the sectors that we think will go up. Like seriously, if we talk about Bursa, I'm still in tech.
Yeah. Hey, but
My
alright,
money flow. Yeah.
you see our FY portfolio, right? The
Yeah.
peak is
Yeah.
68, something like that. It means that
Oh
100%.
yeah. Okay.
Yeah.
Yeah.
But
Yeah.
we also affected by after the budget thing, because we expect
That's true. That's
after
true.
the budget announcement, market's going to be better and whatnot, right?
That's
So
true.
we
That's true.
also affected by that, right? But again, is come back to money management, right? Your portfolio
Yeah.
management.
Yeah.
So yeah, just not to say that we are, what everything that we say here is correct or not, right? You do your own due diligence, but this is our opinion, right? Hopefully it can help you to make sense, to help you uh, thinking, right, about how
Yeah.
you manage your portfolio. Yep.
So guys, again, you guys know us, Facademy. We've been on live for quite some time. We also offer courses. We also have a group. If you guys are interested, reach out to us, right? Drop us a DM. You can join our courses at very, very, very affordable prices. Join our group for very affordable prices. Want to see how we trade, what's our market outlook, how we, our moves in the market, all this. Yeah, please feel free to reach out to us, right? Um, thank you, Aini, Tan, David, Casey, Harry. Thank you guys. Is there anything else before we end this call, end this session?
uh, for me it's nothing.
The most important thing is seriously, we can't lie to ourselves in this year. We have to know that okay, the markets are going to be gloomier, right? We already got the shit
Challenging.
coming out to this. Is all we need to do is handle that shield and say okay, you know what, we're going to be protected, right? And that comes into portfolio management, that comes into knowing what we're doing, not just simply buying on dips, raising cash positions, all these stuff, right? We've got to be mindful of all these. So yeah, that's all for today, guys.
Yeah.
Thank
Oh,
you.
actually, last,
Yeah,
you guys also need to understand our context. So if you just participant in stock market, you investing and trading, just trading and invest as usual, right? if you put your money every month on the stock market,
Yeah,
keep doing that, right?
for sure,
Yeah,
for sure.
yeah. So yeah, I think that's all. Yeah.
Awesome. Thanks, guys. Bye bye.
Bye.